Thursday, April 30th, 2020, MONERO 64, home of alternative economics and contrarian views. So today I want to talk about how the Fed and Chairman Jay Powell are not your friends. They're not looking after the interest of the general public, even though Fed chairmen always say that they've been given these missions by Congress to keep stable prices and full employment. But they never talk about the fact that they're actually the biggest peddlers of debt on the planet. And I'm going to go through the numbers today and some charts to prove that. So what's made me want to talk about this? Well, there was an FOMC meeting, which is the Federal Open Market Committee meeting of the Federal Reserve. They do it every 6 weeks or so when they decide on whether to change monetary policy, to change interest rates, to give their, forecast for the economy. They also hold a press conference half an hour after the announcement. A press conference, of course, conducted by the chairman, Jay Powell. I listened to it last night, London time, where I am in the UK. And I'll put a link to the Federal Reserve YouTube channel. They've recorded the press conference. It was live, of course. It was a Zoom press conference. Funny how Chairman Powell was actually standing up and all the reporters were actually sitting down. Just goes to show you their mind set that he's in charge, that he knows everything, of course. But another interesting thing before I go on to what he said in relationship to a question is the fact that I was following the live stream yesterday of the press conference, and at the end I took a screenshot, and as you can see there, they had 316 thumbs down and 314 thumbs up right at the end of the press conference. It might have changed a little bit afterwards. I don't know how long they kept it there. So there's quite a bit of division there in terms of what people think about the Fed. If you look at the recorded press conference now, which is what I'm putting a link for, they've disabled the counter on the like and dislike button, so you can't see how many people liked or disliked. I wonder why. Anyway, when I say the Federal Reserve and the chairman are not your friends, I mean the general public, the bottom 90% of Americans, and I would say the bottom 90% or even more of everyone around the world. Of course, the Federal Reserve is the central bank for the world. It still holds the title of reserve currency, the Federal Reserve note, aka the dollar. The interesting thing about the question that I'm going to look at, one of the reporters asked Jay Powell, is that they left it to the last question of the live stream. And I'm sure this was decided before the press conference because Chairman Powell, if you notice, when people ask him the questions, he seems to answer right away, which shows me that it's a scripted press conference. He knew the questions before, and he probably decided who was going to ask the questions first, second, third, and who was going to ask the question last. And this is the last question of the press conference, of the live stream. Many people who are sad enough, like me, to listen to this, probably would have gone off to another channel by then, another YouTube channel, to listen to something else. They probably would have been tired of listening to Jay Powell, but I didn't. And Nancy Marshall Genzer, she's from a place or an institution called Marketplace. I've looked at it this morning, Marketplace. So who are they? Marketplace.org. It says, we are a nonprofit news organization on a mission to raise economic intelligence of the country. So that's quite interesting. The question she asked was about savings. She said, with zero interest rates, Don't you think it's hurting savers? So Jay Powell's answer is that Congress has given the Fed the mission to keep low unemployment or full employment and stable prices. And that's what they're working on. Yes, savers are not going to benefit from this unless they have money in the stock market and money in houses, because house prices are going to stay high, and he's trying to get people back into the stock market. He said, I think he said their 401ks are going to look good, and that's what he's looking to do, right? And he said, unfortunately for people who keep money in the bank and try to earn an interest, that's not going to be good. And towards the end of his answer, he said, low interest rates are good for the economy. They keep people borrowing, of course, consuming, and the economy needs low interest rates. So that was his answer. I wanted to look at how interest rates have affected economic growth in the last 50 years or more, or actually it's 60 years, going back to around 1960. So according to Jay Powell, if you raise interest rates, you're going to have low economic growth, high unemployment, and the economy is going to go down the drain, right? That's what he said. That's why they need to keep rates at zero. And before I look at the charts, just look at this. 40% of Americans don't have $400 in the bank for emergency expenses. And that's coming from the Federal Reserve. And this is from May last year. They've done a good job, the Federal Reserve, of keeping Americans from doing the right thing, which is not living beyond their means, working, saving for a rainy day, working maybe and saving enough to invest in a small business. And it's interesting that you never hear Jay Powell talk about getting people to save more so that you can have more investment, because that's the only way to drive investment is through savings. But in his paradigm, the central banking debt-driven paradigm, the way to invest is through borrowing. So let's look at the data then to see if he's right. So I've taken GDP first, which is the gross domestic product of the economy. And as you can see, this is from actually post-World War II. So it goes back even more, 1947. And yeah, the gray parts where the lines go below the black line, those are recessions. But you can see that GDP in the US would touch 10% or more in most of the post-war period up until, let's say, the early 1980s. Yes, you had recessions, but you also had pretty strong growth. And since 1980, as you can see, GDP growth has really gone down quite a bit. The recessions maybe haven't been as many as they had in the post-war period leading up to 1980, and sometimes they haven't been as deep. But the growth has been really anemic. It's mostly below 5%, especially in the last 10 years. There's 1 year here where it goes up above 5%. So that's GDP. So now let's look at the interest rate, because Jay Powell said that low interest rates help growth. So I took the 10-year Treasury yield, US 10-year. And as you can see, it's from 1962 to present. And that from the 60s until the early 80s, that yield was going up, right? And during that period, as we saw earlier, GDP growth was pretty good in the US. There was no problem. And if you look here, ever since the early 80s, the interest rate on the 10-year has been going down. We're almost down to zero now. And GDP has actually become anemic. So his thinking, or his answer to that reporter that low interest rates are good for the economy, doesn't really add up. Am I saying he's lying? No. What I'm trying to say is that what it helps is increase the debt load of the country, the national debt. It helps the bankers. It helps the top 1%. Now let's look at the debt. This is what the Fed has done that is really helped the elite and hasn't helped the public. So, and it corresponds also to when the GDP started like going lower, not growing as much as it used to from post-World War II to 1980. And you can see here that the national debt is ballooned since that time in the early 80s when interest rates started going down. So yeah, if you're into living beyond your means, if you're a Wall Street banker, if you are very wealthy, you don't mind all the debt, all the money creation by the Fed, funny money creation, because you can protect yourself. But I would argue that for the general public, it's making things more and more difficult because there's not as much GDP growth out there. There's not as many good jobs as there used to be, and they're having to borrow more and more. So, and that's why the Fed and the chairman of the Fed, they're not your friends. They're your friend if you like to lead a life of borrowing, living beyond your means, or if you're on Wall Street, as I said. I'm not too sure that the mission of the Federal Reserve, the full mission of the Federal Reserve, is being communicated to the public. Well, if they did, of course, there would be a revolt the next day if Chairman Powell actually told the people the truth, that he's actually there helping the top 1% and the bankers by creating more and more debt. They create it out of nothing. They just type it as an entry onto their balance sheet or onto their system. And he noted it yesterday as well that they're going to continue doing it unlimited. There's no limit. So there you go. So now I want to look at the debt clock, the US debt clock, because it's very interesting, the debt clock right now. It's really accelerating. This is the 2020, this is the present. And I want you to look just below where they have the US national debt. On that same box, towards the bottom, they have US federal debt to GDP ratio. If you go back to 1960, it was 53% of GDP. And look at how that ratio decreased. By the time we got to 1980, it was at 34.5%. Yes, the 1970s were a stagflationary period. There was inflation, but the economy wasn't doing great, but at least the debt decreased. But look at how the debt is increased since then, from 34.5% to 116%. Do you need more proof to see that the Federal Reserve's mission is more debt? The scariest thing about this debt clock is if you go forward to 2024, and I've been looking at this the last few weeks. A few weeks ago, the projection was for like 36 trillion, the national debt. Right now, it's almost up to 42 trillion. And the scariest thing, though, is the debt to GDP ratio. If we stay on this pace of creating a debt like the Federal Reserve and the Congress are doing, we're going to see a debt to GDP ratio of 230%. I also wanted to show you more data from the Federal Reserve. And it's funny because the Federal Reserve, they give you all the data. It's just a matter of you digging and interpreting it. Not just listening to Jay Powell saying that they're trying to help people. Because they're not, if you look at their data. So this is the distribution of financial accounts. It is published by the Board of Governors of the Federal Reserve System. So this is household wealth in the US since 1989. It doesn't go further back, so this will have to do. But this just goes to show you how the inequality has grown. 1989, the top 1% own 23.5% of all household wealth. The 90 to 99 percentile owned 37.2. So that was around 60% of all the wealth was earned by the top 10%. And then we go to the bottom 90%. They owned about 39%. So let's go and compare now, see where that distribution is. So the top 1% now are up to 32.5%. The top 10% are up to 70% of all the wealth. They've gone from 60%. And let's look at the bottom 90%. So the bottom 90% now own about 30%. And more incredibly, the bottom 50%, they've gone from owning almost 4% of all the wealth to owning just 1.4%. And you can bet those numbers are going to get even worse for the bottom 90 and bottom 50%. And they're going to get even better for the top 1% and the top 10%, right? This crisis is going to make sure that will happen. So hopefully that will prove to you that the Federal Reserve and Chairman Powell are not your friends, unless, of course, you're at the top, very wealthy, top 10%, especially top 1%. So what do you do to fight the Federal Reserve? Well, it's hard, I have to admit. I would say personally, the best thing to try to do is not to try to play their game. And what do I mean by that? Well, try to live within your means. Try not to buy into all the propaganda that you see on television and everywhere else. I remember in the 80s, I was in the States. I went to university in the States, and there used to be a commercial about mortgages and buying a house. And the slogan was, "You can have it all," right? Some of you probably remember that advert. I always thought that was weird because, yeah, we want everything always, but sometimes we can't get everything. And I think that mentality, you need to get out of that mentality. You need to do what's right for you. I think that's the only way to try and fight the Federal Reserve, because all they're doing is pushing debt on the public. And the people who benefit the most from that are the bankers and the big corporations, because they get access to that debt first, and they can pass it on to you. And they, with the proceeds that they get for peddling that debt, they buy real assets. And when you borrow, the collateral is always real things, and they'll come after those real things, the Federal Reserve and the bankers. So that's what you have to try to do. Change your paradigm. Try not to deal with these people. Live within your means. Try not to have to borrow. Rent if you have to, if you can't afford to buy a house. So what I think is happening to the United States is what John Perkins has talked about, what the American empire has done in countries like Latin America and other places around the world, like in the Middle East. He's written a couple of books, maybe more, I'm not sure, but The Confessions of an Economic Hitman, and also The Secret History of the American Empire, John Perkins. And basically what the American empire does, CIA and the military industrial complex, is they go to countries, they try to peddle them with the debt through the IMF and World Bank. If they don't accept it, they get rid of the leader, and then they push on projects and they indebt the country. When the countries go bust, they take possession of the real assets of land, all the collateral. And unfortunately, I think that's what's happening in the United States. And it's been happening covertly for many years. So, yeah, it's an American empire. but it's going against its own people, and the Federal Reserve is the financing arm of this. Recommend John Perkins' book. I'm not sure if he's kind of equated what they're doing to emerging market countries or Latin America to what they're doing to the United States now. Maybe he has. So let's quickly look at the markets now. I know this has gone on for a while, but people have more time right now to watch YouTube videos. The stock market rallied quite strongly yesterday on the back of stories about a new drug. Gilead is the company that's supposed to have this drug that improves the treatment for this disease. I've listened to some people talk about it. It doesn't really cure the disease. It just improves the recovery. I'm not sure if this is going to be a big deal, but yeah, the stock market has rallied. I still think it's not based on reality, and I think things are going to get worse economically. So let's quickly see where we are right now. It's 8:30 a.m. London. Gold and silver are doing fairly well. Gold is back up towards 1720. That's where we are right now, up $7. Low has been 1708 and the high 1721.60. I don't think there's anywhere to hide for savers. In the bank, they're not going to get any interest, as Jay Powell said, and is going to make sure they don't. And the Federal Reserve and other central banks are going to continue to print trillions upon trillions. The national debt is getting out of control, as you saw. 230% of GDP if we don't change things by 2024. That's a huge number. You should be concerned if you have fiat currency savings, in my opinion. That's why the dollar and all other fiat currencies are going to continue to drop versus the ounce of gold. This is not gold or silver going up. It's the currencies that are sinking. Too much supply, of course. Silver right now is at 1540, up 12 cents or almost 1%. The Dow is up 90 points or 1/3% at 24,700. S&P 500 is at 2952, up 14. NASDAQ 100 future is up just over 1% at 9,083. I think there are some good results from Microsoft and others. The pound is down 0.2% at 124.45. Euro is unchanged at 108.74. And the dollar is unchanged versus the yen at 106.62. Oil is continuing to bounce back up here. We're almost back up to $20. It's at $18.19, up 10%. Be interesting to keep an eye on that. I think now the range could be $10 to $20 and possibly even see it drop below 10 again. That's my view. So to finish off, the 10-year yield is at 61 basis points. So pretty steady, the 10-year notes and the bond market for now. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to the channel if you haven't yet. And you can also follow me on all other kinds of platforms like Twitter, Facebook, Hive, Library, BitChute, and Steemit. I wish you all a great day. Take care. Bye.